U.S. economy is teetering on the edge of collapse, and there's one critical warning sign in the financial system that almost nobody is paying attention to. While everyone hopes artificial intelligence will save us in 2026, the real story is far more alarming. Something strange is happening in the repo market, and it reveals just how fragile the American economy has become. Every single night, about $12 to $13 trillion flows through the financial system as banks and institutions settle their accounts with each other. Think of it as the plumbing that keeps money moving. Banks loan money to cover these transactions until morning, charging tiny fees that add up to massive profits on such enormous amounts. The interest rates for these overnight loans are set by the market, but the Federal Reserve keeps them within a specific range, currently between 3.5% and 3.75%. When rates try to break out of this range, the Fed steps in by lending money against assets like Treasury bonds or mortgage securities. This intervention is normal during major financial crises like the 2008 collapse or the COVID pandemic. It sometimes happens on the last day of a financial quarter when companies are adjusting their books, but it almost never happens at other times, except now it is happening constantly. Throughout the final months of 2025, the Fed had to inject billions of dollars into these overnight markets week after week just to keep rates stable. Every blue line on the chart represents billions of dollars the Fed pumped in to prevent the system from breaking down. This hasn't happened outside of crisis periods since the global financial meltdown. Markets used to panic when this occurred because it suggested a hidden liquidity crisis somewhere in the system. Today, because the Fed can intervene so quickly, traders barely react to isolated incidents. But a sustained pattern like this signals something completely different. It means the big financial institutions that can see each other's activities don't like what they're seeing. When banks demand higher rates to lend to each other, they're charging a risk premium. They're worried about something in the credit markets. They're circling each other like suspicious dogs, unsure whether to trust or attack. For ordinary people, this means one thing. No matter how much the Federal Reserve wants interest rates to fall, the market has other plans. These interbank rates reflect a credit crisis that's consuming American consumers and threatening the entire economy. The 10-year Treasury rate serves as the foundation for a mature economy. It's the benchmark that determines mortgage rates and credit card interest. Despite claims of record-breaking investment and economic growth, the market isn't buying it. The cost of U.S. debt remains stubbornly high. Even as the Fed cuts rates, this represents another risk premium. The entire world is demanding higher returns to lend money to America. While Treasury rates don't directly control consumer credit rates, they set the floor. Your mortgage and credit card rates will never be lower than these benchmark rates, and the spreads above them certainly won't shrink. This means borrowing costs will stay elevated for the foreseeable future. Why is the world essentially betting against the American economy right now? Because Americans are drowning in debt. Not just the government, though that's part of it, but individual citizens. This wouldn't be as concerning if there was a clear path out of this debt trap. But right now, we're caught in a credit spiral that's accelerating. Household credit card debt has reached an all-time high. The reason comes down to two main factors: wages and inflation. When the cost of living exceeds what you earn, you borrow money to survive. Despite promises that prices are falling fast, the data tells a different story. Consumer spending represents 70% of America's economic output, so the price of goods and services matters enormously. If you ignore the massive spike during the pandemic recovery, current price levels are flat or even higher than they were a year ago. This is happening even as the global economy slides into recession. Oil prices have dropped into the 50s, yet inflation still hovers around 3%. The economy is shedding jobs at record rates, even after deporting hundreds of thousands of people and shutting down immigration entirely. Under these conditions, we should be seeing deflation or at least disinflation. Neither is happening. The most recent inflation report claimed rates dropped from 3.1% to 2.7%. But this report was based on incomplete data. 90% of the usual data collection was missing. How can anyone know the real inflation rate when almost all the information is absent? Beyond inflation, wages tell another part of the story. Claims suggest that wages are rising much faster than inflation for the first time in years. But wage growth adjusted for inflation is hovering around 1%, essentially flat compared to the previous administration. Even taking these wage claims at face value, the question becomes how many people are actually working. Claims that more people are working now than at any time in American history fall apart under scrutiny. Labor participation was actually higher under the previous administration. To make the claim true, you'd have to exclude data from every administration going back to the 1970s. Consumer confidence has fallen to the lowest point ever recorded. Not during COVID, not during the 2008 financial crisis, not during the dot-com bubble, not during the 1970s stagflation. Ever. We are deep in recession. Through November of 2025, 711 companies filed for bankruptcy, the highest number since 2010 in the aftermath of the financial crisis. That's up 14% from the previous year. 41,000 households also filed for bankruptcy, up 8%. The peak season for bankruptcies typically hits in March and April, meaning the worst is still ahead. Now the picture becomes clear. The financial system's plumbing is failing almost weekly. Consumer confidence sits at an all-time low while household debt reaches an all-time high. Fewer people are working, inflation continues raging, and the biggest trigger for collapse hasn't even been pulled yet. What could that trigger be? The AI investment bubble, private credit markets imploding, war in South America, a stock market correction? All of these might play a role, but the real danger might not even originate in America. The monetary crisis could start in Japan. The Japanese economy is falling apart. As inflation rises in Japan, the Bank of Japan has begun raising interest rates and signaled plans to keep raising them throughout 2026. This directly impacts America because Japan is the largest foreign holder of U.S. debt. For decades, Japanese treasury rates have been near zero. This made it profitable to take advantage of a weak yen, convert it to dollars, and buy U.S. treasuries. Now that Japanese rates are rising, Japanese capital is flowing back home. This unwinding of what's called the yen carry trade is just beginning. The most recent Treasury International Capital data shows the United States experienced outflows of dollars from both private and official sources. This confirms that U.S. dollar dominance and American exceptionalism are finally ending. The rest of the world now believes America is on the wrong path and has viable investment options elsewhere. Foreign holdings of U.S. dollars as reserve currency are near an all-time low. The translation of all this global financial data is simple. The narrative of selling American assets is very real. The result is that the cost of capital will remain very high. Mortgages, credit cards, lines of credit, everything. Combined with falling consumer confidence, 2026 will be brutal for consumers. This lack of confidence means people stop spending, which eventually destroys corporate earnings. This creates more stress in private credit markets, more Federal Reserve interventions, and tighter credit everywhere. This is how economies grind to a complete halt. Some of this is normal. Capitalist economies are designed to boom and bust. Recessions are a feature, not a flaw. Over the years, economic systems have learned how to intervene to limit widespread pain, but current signals suggest any interventions will focus exclusively on protecting banks. The entire economic plan assumes tax refunds will be so large they'll create an economic boom. But the math simply doesn't work. Looking ahead, several factors will determine America's economic fate. Will the unwinding of the yen carry trade lead to panic selling of U.S. debt? Will inflation surge once complete data becomes available? The labor market is already collapsing, but will official figures finally reflect reality? Will the dollar continue losing value compared to other currencies? These trends could combine to pop multiple bubbles and cause severe downturns across many sectors. With healthcare costs about to skyrocket and tariffs plus dollar devaluation continuing to drive inflation, consumers are trapped. These forces alone could cause credit markets to seize up, forcing the Fed to flood the financial system with dollars to prevent regional banks from collapsing. The long-term effect of this spiral is a flight away from the dollar as the world's reserve currency toward a new system, probably involving digital currencies backed by commodities and precious metals from emerging economic blocs. These changes are already underway. Any long-term U.S. recovery will require far more than just data centers and power plants. This economic reckoning might have been inevitable eventually, perhaps years or even decades away. What may have happened is that this faraway threat has been brought directly to our doorstep right now. The question is no longer if the crisis will arrive, but how severe it will be when it does. Claude is AI and can make mistakes. Please double check responses.